Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about the 2022 recession, how it's here, how to prepare, and how to profit from it. So let's get right into the presentation that my research analyst and I put together. My research analyst's name is Joe Consorti. He's on Twitter. If you haven't checked him out there, please do so. So let's start with this first slide here. This is GDP growth per quarter. So what is a recession? Why am I showing you this? So a recession is generally identified by a fall in GDP in two successive quarters, meaning two back-to-back quarters. So this chart is just showing you basically quarter one of 2018 all the way to quarter one of 2022. Quarter two of 2018. There's only 3 bars here. So we had positive growth, or at least positive GDP, not necessarily growth, all the way from 2018 to basically 2020. And then we had 2 quarters of consecutive negative growth, which is a recession. This happened in quarter 1 and 2 of 2020. And then we had crazy growth in Q3, and then it's kind of leveled out since then, okay? However, in quarter 1 of 2022, this was the first quarter which we had negative growth since quarter 2 of 2020. So if we don't have 2 quarters of negative growth, why am I saying the recession is here? Well, this is why. Because right now, according to the Atlanta Federal Reserve, or the Atlanta Fed GDPNow, real GDP estimates for quarter 2 of 2022, this is the quarter that just ended, is coming back at negative 1.5. The reason I say 1.5 and not 1.2 is because this is updated weekly. You can see how it's been dropping basically since May. And this is actually sitting at negative 1.5 at the time of this recording, not when this chart was made, okay? So that would technically put us in a recession. So let's take a look at some charts here that kind of verify these things that are kind of leading indicators. Some of these are leading, some of these are lagging, but I think it's important to understand all this. So this is small business optimism, okay? This is a chart or a survey that goes out to several small businesses in the United States monthly to survey the health of their business. These kinds of businesses make up over 50% of the private workforce in the United States. So let's take a look at this. So the small business optimism is lower than the start of the great financial crisis in 2007. So as we take a look at this arrow, we bottomed out over here kind of like in the 82, 85 range, if you will. It's a little bit less than 85, a little bit more than 80. That was after the great financial crisis. We bottomed out over here after 2020, that brief recession that we just talked about. And then now we are sitting at 89.5, okay? So this is actually lower than the start of the 2007 great financial crisis, but not as low as the bottom of that. So what we're seeing is these small mom and pop businesses, they're hurting and they're not having very much confidence in their business right now. The same thing with consumer sentiment. So consumer sentiment, this is a survey done by the University of Michigan. Go Ohio State Buckeyes. Consumer sentiment is measured in a survey by the University of Michigan and is showing that it's lower than the great financial crisis. So even at the bottom of this trough right here in 2007, 2008, 2009, we're actually sitting at 50. Okay, so 50 is down here. You can see where 2007 was. If you take a look at March of 2020, which is right here, this is still significantly higher than what we're looking at right now. So the reason for this, I think, is because inflation is really getting to people. What I mean by that is I think people don't really know where to put their money. They're scrimping and saving. Their savings rates may be higher. However, their actual confidence and their sentiment is much lower. So, but if we take a look at this chart was only since 2000, okay? So if you actually go to this next chart, this one goes all the way back to 1978, and this is actually worse than the 1979 oil crisis. So if you look at my laser pointer on the bottom left side of your screen, this is the 1979 oil crisis. If you go all the way back, or all the way to today's date, this is the lowest ever for consumer sentiment. So the people and their businesses are signaling. These are the plebs. These are the people that run the economy. When they're hurting, a market downturn is approaching. So this is the slide that I threw in here. This is the ISM Manufacturing PMI, Purchasing Managers Index. 47, which is this red line right here, is considered the agreed upon line for official contraction. It's kind of the threshold preceding recessions typically. So if we take a look at early 2000s with the dot-com bubble, if we take a look at the great financial crisis, if we take a look at 2020 with Corona, you can see right here that all of these have fallen below that line. And we're actually starting to come down again. So we're sitting well above this line at 53. Again, this is not a fear-mongering channel. I'm just giving you facts. You can form your own opinion. But we are sitting at 53 right now with the ISM Manufacturing Purchasing Managers Index. Okay, so this is the big slide. This is the one that typically precedes recessions. It's a precursor to recessions. I'm sure you've heard of this, and I'm sure you've heard of this term. We're looking at an inverted yield curve. Okay, so a 2-year versus a 10-year Treasury spread. This is basically talking about how the 10-2 Treasury yield spread is the difference between the 10-year Treasury rate and the 2-year Treasury rate. So the 10-2 Treasury spread that approaches 0 signifies a flattening yield curve. We're actually sitting at -3 right now, as you can see right here. So a negative 10-2 yield spread has historically been viewed as a precursor to a recessionary period. So again, going back to late 90s, early 2000s, great financial crisis. 2018, this was basically when the stock market crashed after they kept raising rates. And then we had 2020, and then now we're actually lower than that right now. So this has typically been a good indicator or precursor to recessions. So growth expectations, this is basically the 10-year Treasury yield. As we can see, it's mapped out here. It goes all the way back to 98 in this slide to 2022. Growth expectations typically top out before every major recession. You can see where all the circles are, and you can see the 10-year Treasury yield essentially representing growth expectations. So after we had 2018, it went down, Cerveza right here, and then now we're sitting at it coming all the way back up. If this keeps going up, this could be a good indicator of growth expectations topping out before a recession. So this slide right here, I've used this in another video. I think it's important, though, because not a lot of people talk about this. We're talking about rate cuts coming soon. Okay, I talked about this in my podcast with Macro Alf. He talks about how the Fed, or the bond market, is already pricing in Fed rate cuts in 2023. So if we take a look at this chart, y-axis 1 is talking about the implied policy rate, the percentage. The blue line is the implied policy rate, as we can see here, topping out at 3.58%. This is basically what the Fed is targeting. Orange or yellow, depending on your screen, is the number of hikes or cuts priced in. So that's y-axis 2. You have 0 cuts, 1 cut, 2 cuts, 3 cuts, 4 hikes, cuts, whatever. If it's going up, it's a hike. If it's going down, it's a cut, right? Common sense. So with rate cuts, increasing the velocity of money, meaning that money is cheaper. Oh, sorry, Creative Cloud has been updated. Oh, nice, thank you. Sorry. So this is essentially used to stimulate a slowing economy. So when you start cutting the rates, companies start taking out cheap debt. This is basically what fueled everything for the past 14 years. So if we start to see these rate hikes keep going, they're trying to stop inflation. They're trying to slow things down. They're trying to cool off inflation. This is the point at which we start to stimulate again, and then now there will be cuts. The x-axis down here is basically dates. So this proposed date is the end of Q1, 2023. The specific date, if you can't see it, is March 22nd, 2023. So as we move on here, you can see the next slide is basically unemployment. So unemployment is a lagging indicator that bottoms out before every major recession. You can see employment is bottoming out again. So if you take a look at, this chart goes all the way back to the 1950s. Y-axis is the percentage of unemployment rate. You can see it bottoms out, then skyrockets. Bottoms out in the 70s, then skyrockets. All these gray lines are recessions, by the way, you guys, in case you didn't know that. When you look at these charts, that's what these gray columns imply. So if you look at 2000, bottoms out, explodes. 2008, bottoms out, explodes. You look at Cerveza, bottoms out, then really explodes because people were taking advantage of stimulus. And then now in June of 2022, we're sitting back at 3.6%. If you want to know when your boy graduated with a finance degree, December of 2010, peak unemployment at that time period for that generation, sitting at 10%. Nobody was hiring. Okay, and then Oracle, considering thousands of layoffs, labor market slowdown, layoffs, right? So people are slowing down in hiring. They're actually laying off. I referenced this in my last video, the everything bubble. We're starting to see tech companies do tons of layoffs over the past year or so, and we're going to continue seeing this. You have Meta, you have Coinbase, you have Tesla, you have Oracle. This is what's going to be happening, and this all ties back to recessions, you guys. Jobs are super important for stability. So talking about stability, let's get into defensive strategies. So what is the whole point of this video? How do we benefit, and how do we strategically position ourselves to benefit and also play defense? So let's start with defense first. Defense wins championships. So pay down high percentage debt unless we're seeing hyperinflation. So a lot of people don't understand this. Pretend you have $100,000 on your kitchen table, right? And you go through hyperinflation. So the person that has the mortgage, the car loans, the this, the that, they're able to take that hyperinflated currency and easily pay off that debt, okay? Because they only owe X amount of dollars, which hasn't moved at a fixed rate. Your currency hyperinflates at a much higher rate. You pay down the debt that you took out in year zero with ease. Now let's pretend you have no debt and you have 100 grand sitting on your kitchen table. If your currency hyperinflates, what can you buy for that 100 grand? Okay, maybe a chicken, maybe some toilet paper. That's obviously a worst case scenario, but that is a realistic scenario in countries like Venezuela, for example. So pay down high interest rate debt unless we're seeing, hyperinflation. Then it makes sense to have debt. Always have the emergency fund. I'm a huge proponent of an emergency fund. This is how you build your foundation, how you build your skyscraper. 3 to 6 months if you have a job, 12 plus months if you are in commission sales, if you're an entrepreneur, if you have an unstable income. Number 3, do not panic sell, okay? I had a million consulting calls in March of 2020 when the market was crashing. People were asking me, hey, Marco, what should I do? Should I sell? Should I sell? I just told them what I was doing, okay? I wasn't giving financial advice, just telling them what I was doing. I didn't sell a thing, didn't sell a penny, okay? Didn't sell a share. The reason for that is because you need to be a long-term investor and know what and why you're investing in the first place. If you're holding butt floss coin, that's a big difference than holding, a blue chip stock or a blue chip ETF, for example. I invest for the long haul. I'm not some FOMO, hype investor that's on YouTube or TikTok, for example. Those people, I save them a lot of money by telling them that because the market just exploded a few months later. So maintain your income via job or side hustle. I know that sounds like common sense, but the reason for that is because we're going to play offense right here. So you need to build up your cash flowing assets. During recessionary periods, this is a great time to scoop up some real estate. It's a great time to scoop up some underpriced dividend stocks. It's a great time to scoop up long SPY. If you want to trade the SPY, I don't want to get into specifics in this video, but you can actually sell covered calls and create a monthly income or weekly income that way if you want. So build up your cash flowing assets, monetize your skills, bring value to the marketplace, and build up your free cash flows. You can use these cash flows to purchase cash flowing assets, aka real estate and the things that I just mentioned, because there will be a fire sale, okay? So what people don't realize is after 2008, people built generational wealth, okay? My lawyer bought up properties for 30, 40 grand here in a suburb of Cleveland. This is a place that I could live. We're not talking about the hood. We're not talking about a war zone. Now those same properties are worth almost $200,000, and they've been renting for $1,200, $1,300, $1,400, $1,500 a month this whole time. Bought those in cash. That was in 2011, 2012, 2013. Buy systematically, okay? Dollar cost average. I've been talking about this forever. Smart money buys into weakness and it sells into strength, okay? If you are holding an asset that's appreciating, you don't even have to do this part. You don't even have to sell. Smart money buys into weakness. Be greedy when others are fearful, right? So empires are built during market downturns. I just gave you that example. That's the time to start playing offense. So that's all I have for you today, you guys. A lot of this is common sense, but I did want to paint the picture that we probably are going to technically be in an official recession in a couple weeks here after the numbers come out. I did want to show you the consumer sentiment, purchasing managers index, rate hikes and cuts. All that stuff is important. If you're watching a finance channel or a finance like a CNBC or whatever, and they're not talking about this stuff, you need to find better sources of information. This is the meat and the leading indicators that actually help you become a better investor and help you become savvy, okay? You can't time the market, you can't predict the future, but these things do help. So play defense, always have the emergency fund, always pay down your high interest rate debt, not necessarily low fixed rate debt. I'm not talking about a 2% mortgage or 1% car loan. I'm talking about 23% credit card debt, for example. Unless you see us going into a hyperinflationary scenario, you can then pay those things off relatively easily as long as your income keeps up with inflation, right? And then offense, I just finished that slide. I don't need to repeat myself. I think that offense is extremely important during these recessionary periods because A, they don't come around often. They're only going to come around maybe once or twice in a lifetime. In my lifetime so far, that was 2008. If you're a little bit older, maybe the dot-com bubble, you could have invested that. Maybe the savings and loan crisis, if you're that old, I don't know. But my point is build your war chest. You should have defense and offense. The offensive part is sitting in cash or being able to raise money from other people. OPM, other people's money. So I hope you got value out of this video. Please give me a follow on Twitter. It's WhiteboardFin, F-I-N. Follow my research analyst, Joe Consorti. And then also check out the links in the description below. I will be coming out with my private membership group here soon. I know I've been talking about it for a while, but I want to make sure that I have the right staff members in place before I launch that. I'm going to have guests. I'm going to have subject matter experts. I'm going to be talking about a little bit of everything that I am an expert in. And it's going to be an unbelievable community, and I highly suggest you check it out. Thank you so much, everybody. Have a prosperous day.